The Intelligent Investor is a classic investment book written by Benjamin Graham, a renowned economist and investor, first published in 1949. The book provides valuable insights and timeless principles for successful long-term investing. Here is a summary of some key points. Value investing. Graham emphasizes the concept of value investing, which involves analyzing the intrinsic value of a stock or security and buying it when the market price is significantly lower than its intrinsic value. The margin of safety. Graham introduces the idea of a margin of safety, which means buying assets at a price significantly below their intrinsic value to protect against unforeseen market fluctuations. Mr. Market analogy. Graham uses the analogy of Mr. Market, a hypothetical investor who offers you a price to buy or sell a stock every day. Mr. Market's mood swings can create opportunities for the patient, disciplined investor to take advantage of market fluctuations. Stock versus speculation. Graham differentiates between investing and speculation. Investing involves a thorough analysis of a company's fundamentals, while speculation relies on predicting short-term price movements without a solid basis. Long-term perspective. The book emphasizes the importance of a long-term perspective in investing. Trying to time the market or engage in frequent trading is often counterproductive and risky. Diversification. Graham recommends diversifying your investments to spread risk across different assets and industries. Diversification helps reduce the impact of individual stock or sector volatility on your overall portfolio. Understanding financial statements. Investors should have a basic understanding of financial statements and key financial ratios to evaluate a company's health and performance. Market fluctuations. Instead of fearing market fluctuations, investors should embrace them as opportunities to buy low and sell high. Emotional discipline. Investors need to control their emotions and avoid making impulsive decisions based on fear or greed. Investment versus speculative behavior. Graham warns against getting influenced by the behavior of others in the market and encourages independent thinking based on rational analysis. In conclusion, the Intelligent Investor promotes a value-based, long-term, and disciplined approach to investing, focusing on sound fundamentals and intelligent decision-making to achieve financial success in the stock market. Chapter 1 of The Intelligent Investor is titled Investing versus Speculating, Results to be Expected by the Intelligent Investor. In this chapter, Benjamin Graham lays the foundation for his investment philosophy and highlights the key differences between investing and speculating. Here's a summary. Defining investing and speculating. Graham starts by differentiating between investing and speculating. He defines investing as an activity that involves a thorough analysis of a company's fundamentals, financial statements, and overall business prospects. The intelligent investor seeks to build a portfolio of quality assets with a focus on long-term appreciation and income. Speculation as a risky endeavor. On the other hand, speculating is characterized by making bets on short-term price movements without adequate analysis of a company's underlying value. Speculators often base their decisions on market trends, rumors, or speculative tips, exposing themselves to higher risks and potential losses. The margin of safety. Graham introduces the concept of a margin of safety, which he considers crucial for intelligent investing. A margin of safety involves buying a stock at a price significantly below its intrinsic value to protect against adverse market conditions and potential declines in value. Market fluctuations in Mr. Market. Graham acknowledges that markets are prone to fluctuations and that stock prices can vary widely from their underlying value. He uses the analogy of Mr. Market to represent the market's mood swings, offering different prices for stocks each day. The intelligent investor should not be influenced by Mr. Market's emotional behavior, but rather should use it as an opportunity to buy undervalued stocks and sell overvalued ones. Long-term perspective. Graham emphasizes the importance of taking a long-term view in investing. Instead of focusing on short-term price movements, investors should concentrate on the underlying fundamentals of the companies they invest in and remain patient to allow their investments to grow over time. The influence of speculative factors. The chapter concludes by highlighting the role of speculative factors, such as public opinion, market trends, and irrational exuberance, in driving stock prices away from their intrinsic values. Graham warns investors against being swayed by these factors and encourages them to base their decisions on rational analysis. Overall, Chapter 1 sets the tone for the rest of the book, establishing the key principles of value investing, the importance of a margin of safety, and the distinction between intelligent investing and speculative behavior. Graham advocates for a disciplined and patient approach to investing, which aligns with the broader themes explored in The Intelligent Investor. Chapter 2 of The Intelligent Investor is titled The Investor and Inflation. In this chapter, Benjamin Graham discusses the impact of inflation on investments and guides how investors can navigate and protect themselves from its effects. Here's a summary. Understanding inflation, Graham starts by explaining what inflation is and how it erodes the purchasing power of money over time. Inflation refers to the general increase in prices of goods and services, leading to a decrease in the value of each currency unit. Inflation and bond investments, Graham discusses the effects of inflation on bond investments. While bonds are often considered safer than stocks, they are not immune to the impact of inflation. As inflation rises, the fixed interest payments on bonds become less valuable, resulting in diminished real returns for bondholders. Stocks as inflation hedges, Graham suggests that common stocks have the potential to act as inflation hedges. Historically, stocks have shown the ability to outpace inflation and maintain or increase their real value over the long term. However, not all stocks perform equally, so investors must choose stocks carefully. The role of dividends, dividend-paying stocks are particularly valuable during inflationary periods. Companies that regularly pay dividends provide a steady income stream to investors, which can help offset the impact of rising prices. Protecting against inflation, to protect against the erosion of purchasing power caused by inflation, Graham recommends investing in a diversified portfolio of stocks with a history of stable earnings and dividends. He emphasizes the importance of fundamental analysis and selecting companies with strong financial positions. Inflation-adjusted bonds, Graham briefly mentions inflation-adjusted bonds, such as Treasury inflation-protected securities, TIPS, which offer investors protection against inflation by adjusting the principal value and interest payments in response to changes in the Consumer Price Index, CPI. Gold as a hedge, Graham discusses the historical role of gold as a hedge against inflation. While he acknowledges that gold may be an option for some investors, he warns against speculative purchases and advises against allocating a significant portion of a portfolio to gold. Practical steps for investors. The chapter concludes with practical advice for investors, including maintaining a diversified portfolio, emphasizing quality and stability in stock selection, and staying informed about economic conditions and potential inflationary pressures. Overall, Chapter 2 highlights the importance of considering inflation in investment decisions and provides insights into how investors can protect themselves from its negative effects. Graham's emphasis on long-term, fundamental analysis and diversification remains consistent with his broader philosophy of intelligent investing. Chapter 3 of The Intelligent Investor is titled A Century of Stock Market History, The Level of Stock Prices in Early 1972. In this chapter, Benjamin Graham discusses the historical trends of stock market prices and their relation to earnings and dividends. The chapter provides valuable insights into the fluctuations of the stock market and helps investors understand the significance of valuation. Here's a summary. Stock market history. Graham begins by examining the stock market's historical performance over the past century, from the late 1800s to early 1972. He notes that the market has experienced significant fluctuations during this period, including bull markets and bear markets. Earnings and dividends. Graham emphasizes the importance of earnings and dividends as crucial factors affecting stock prices. He asserts that over the long term, stock prices tend to follow the trajectory of corporate earnings and dividends, which reflect the real underlying value of companies. Market valuation metrics. The chapter discusses various valuation metrics used to assess the overall stock market. Graham introduces the concept of the price-earnings (PE) ratio, which compares a company's stock price to its earnings per share. A high PE ratio may indicate an overvalued market, while a low PE ratio suggests undervaluation. Earnings growth and stock prices. Graham points out that investors' expectations of future earnings growth can significantly influence stock prices. If investors anticipate strong future growth, they may be willing to pay higher prices for stocks, leading to elevated PE ratios. Speculative market conditions. As of early 1972, Graham observes that the stock market appeared to be in a speculative phase, with some sectors experiencing inflated prices despite their questionable earnings and dividends. This condition raises concerns about potential market downturns and risks for investors. Market timing. While Graham I shall add the balance chapters of the book in another video as part 2. Please check the channel for part 2 of Intelligent Investor. I hope you like the video. Please like, share, and subscribe for interesting videos like this.